U.S. natural gas futures slipped toward $4.50 on Wednesday, retreating from an 8-month high of $4.57 reached Tuesday, as traders weighed near-term mild weather forecasts against resilient export demand and expectations of colder conditions in early December. Traders are closely watching changing temperature patterns, which are easing short-term demand expectations. The cold front that moved through the eastern U.S. earlier this week has passed, with temperatures expected to climb back into the 50s to 80s through early next week. As a result, national demand has fallen from high to light levels, fueling today's intraday selling pressure. LNG exports remain strong, with shipments to the 8 major U.S. terminals averaging 17.8 billion cubic feet per day so far in November, fueled by persistent European demand amid curtailed Russian supply. At the same time, U.S. gas output in the lower 48 climbed to a record 109 billion cubic feet per day this month, ensuring comfortable storage levels about 4% above seasonal norms, a factor largely ignored by traders focused on the upcoming cold stretch and export strength. Meanwhile, 3 U.S. regions, the Permian Basin, Appalachia, and the Haynesville, each produce more natural gas than most entire countries. Together, they account for roughly 70% of U.S. output, with volumes so large that each region alone rivals top global producers like Qatar or Iran. This dominance underscores how regional supply trends in the U.S. can shift global balances, with even minor production changes from these basins influencing international LNG prices and trade flows. Meanwhile, the EIA reported today that U.S. oil production is now expected to reach an even higher record this year than previously projected. Rising oil production tends to be bearish for natural gas, as it leads to higher associated gas output, increasing overall supply in the market. With record U.S. gas production and storage still above average, traders may grow cautious, increasing the risk of a pullback in prices. From a technical perspective, short-term momentum is weakening, and the market has a 60% probability of consolidating between $4.35 and $4.60. A drop below $4.35 could push prices toward $4.20 with 25% probability, while a break above $4.57 could target the $4.60 resistance zone with 15% probability, although upside is limited without stronger bullish drivers. Overall, natural gas is under pressure from high U.S. production and ample storage. The near-term bias is neutral to slightly bearish, with any sharp moves likely driven by weather changes or unexpected LNG demand. Don't forget to check out the ads and leave a comment to support the channel. See you in the next one.